Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is New York Times bestselling author Larry McDonald, and he is also the founder of the Bear Traps Report. Larry, welcome to Wall Street Silver.
Thanks, Ivan. I've wanted to be on this program for years. I hear so much about the controversy and the ideas generation. It's
Yeah,
very
well,
inspiring.
it's a pleasure having you on, Larry. And looking at the whole everything that's happening in the market and the chaos, we have some serious issues with the U.S. policy now being too heavy-handed, making countries want to basically ditch the U.S. dollar. And it seems there's a trend now that to reduce the U.S. Treasury holdings, and at the same time they're increasing their gold reserves, like countries like China. Is this having a long-term effect? What's your thoughts?
Well, sanctions and taking possession of capital, those are weapons that should probably be used, aggressive sanctions against many countries. Those things should be used like once a decade. But it's really the classic hubris in Washington where politicians don't understand the risks of some of these moves. And the hubris is that one of my favorite words because I wrote the Lehman book, Colossal Failure of Common Sense. It's now in 12 languages, and it's a story about the Lehman collapse, but it's really a story about hubris and the management team at Lehman Brothers.
Mm-hmm.
And the hubris in Washington, both on the GOP side and the Democrat Party side, is pretty spectacular, considering that by using these sanctions over and over again, you're incentivizing capital to flow away from dollars. Now, the good news is we're just in a phenomenal driver's seat. And so the dollar's not going to disappear overnight. It's going to take a long time. But the problem is, after last year with the spectacular, all the things that were driving capital to dollars, like the war, China lockdowns, situation in Japan with the yen, very weak currency. So all these things were driving, and then situation with the United Kingdom with the LDI scandal, or what we call the collapse of the LDI system, and the pension problems. All that was driving capital into dollars. And if you look back the last 60 years, 2022 is going to go down as probably one of the top three all time, with the war, like I said, with all these things driving money into dollars. And now the rest of the world is coming out of COVID. China's reopening. The Fed is also in a much different position. They're probably at the end of the hiking cycle. Last year, it was the most aggressive hiking cycle probably since the 70s. So that was also supporting the dollar. So for this to happen now around this LNG transaction and this typical start of a major decay away from the dollar, it's at a pretty bad time, because all the forces, the tailwinds that were supporting the dollar in 2022, just about every one of those has reversed for 23.
Mm-hmm. Like China now and France, they just settled their first LNG trade in the Yuan, and that really woke up some people. Like that shook the world almost. How serious is this, Larry, in your situation?
Well, it's serious over time, because these transactions will get bigger and bigger and bigger. But we're still 65 or 62% of all trades in dollars, and the dollar-denominated debt that's issued globally is still just a tremendous amount. I mean, you're talking about the U.S. market share is so strong. So in the immediate like next year, it's not so much a threat. But like I said, if the Fed is at the end of the hiking cycle, that's a big negative for the dollar. One of the things that I learned in my career is that there's two major forces that drive the dollar. One is what the Fed is doing relative to the other central banks, right? And so last year, the Fed was the most aggressive central bank in the world. The rest of the world was in a much more quiet spot. Now, if the Fed's at the end of the hiking cycle, that's a huge drag on the dollar. And then the other fact is there's 64 trillion, 65 trillion of GDP outside the United States, just under 30 trillion in. So if that's 60, it's really more like close to say 68 trillion. So if that 68 trillion of GDP is stabilizing or improving because of the China reopening, because of the potential détente this year with war, very high likelihood of some type of resolution this year, all of that's going to be an enormous drag on the dollar. And then when you add in this element, it also adds in another drag. So it's like three drags in one.
You said in a recent interview to sit back and have some common sense. From 2020 and 20 to 2021, trillions of dollars of mortgage-backed securities were sold. And you were talking about how bad that scenario is long term. Can you explain that to our audience?
Well, okay. So when the Fed suppresses the cost of capital for longer and longer and longer and longer periods of time, it enables idiocy. Because if you think about the banking system in the United States, if you walk into JP Morgan and you're on their interest rate derivatives desks, it's like being a top gun. I mean, you're talking about a incredibly talented group of people that know how to hedge interest rate risk. I've been on that desk. I've been on the desk at Lehman. I traded high yield bonds, distressed bonds. I know a lot of I know some of the best fixed income traders in the world.
Wow.
Those big banks are completely set up for any kind of move in rates, pretty much. But the smaller banks, because you suppress the cost of capital for a decade, and then the Fed lectured everybody in 2021 that this was transitory. So you basically incentivized the regional banks to fire. Like they don't have interest rate hedging departments. They probably did. They did in the 70s. They probably did in the 80s, maybe in the 90s. But all those people have been wiped out, right? And so you're talking about hundreds of banks that just got table max long duration. And what I mean by that is, instead of when you take in deposits, you take in $1 billion of deposits, or hundreds of millions, and you're supposed to put that somewhere. You can put it in 1-year treasuries, 2-year treasuries, 1-year mortgage-backed securities, commercial real estate, CMBS. But a lot of these banks went out to 7 years. And so the convexity of, let's just say you have $1 billion in a 7-year bond and it's 1% coupon. If interest rates go from 1% to 4 or 5%, that $1 billion could be worth 800 million. So you lose 200 million. And so as a bank, you lose $200 million in just interest rate risk. That's not counting potential risk from mortgage-backed securities, and that's not counting potential credit risk from commercial real estate. So that created this whole run in the bank where certain banks were cheating. They were reaching for yield, and it was okay to reach for yield because the Fed told you and suppressed rates for so long that each year that went by, there was more and more cheating and reaching. And that's what's caused this crisis.
So, Larry, is there more to go in this banking crisis, or has the Fed given some larger insurance backing to these banks? Like, what do you think? Is the banking crisis resolved or no?
Well, we run a Bloomberg chat, and that's a chat room with institutional investors, some of the largest hedge funds, mutual funds, and pension funds in the world. We run it on Bloomberg in 21 different countries. And so we have a group of, if you picture in your mind a theater, right, with 650 people in the theater, in the seats. And during the day, it's like a live ideas dinner where we have certain people beyond the stage having conversation. And so it's a little bit like artificial intelligence in the sense that we're, through a mosaic process around the world, we're gathering a thought stream from some of the smartest hedge funds and mutual fund managers in the world, and a lot of them trade fixed income. The one thing that people are talking about, and I'll share some of the slides with you, this is clearly a contagion from your LDI situation in the pension system in the United Kingdom in October. Those were really bad interest rate bets that caused a massive credit weakness that actually forced the Fed to soften the path on October 21st at 7 o'clock in the morning. Nick Tamaranos was somebody leaked from the Fed, a softer path to him, and the market ripped from October into November. The Dow had the best 30, 40-day period since since World War II, right? So that's that softening there. And then the next thing was obviously the regional banks, and then Credit Suisse. Now people are looking at Deutsche Bank. Credit default swaps on Lincoln Financial and MetLife are trading above Morgan Stanley and Goldman Sachs. So the cost of credit default protection on insurance companies is blowing out. The cost of credit default protection on Capital One is blowing out relative to American Express. That tells you that the subprime consumer is really wounded. So this is a rolling credit crisis, and it's not going to end until there's a much bigger backstop from the fiscal side and the monetary side. In other words, if you think of Lehman Brothers, right? Lehman goes down. We talked about this in my book. It's like a 50,000 ton cinder block going into the ocean. It impacted many, many banks and insurance companies globally. This is like smaller blocks going into the ocean, but the dynamic is very dangerous because this is rolling from the banks to the insurance companies to the consumer. And the FDIC protection after Lehman, we guaranteed after Lehman money market funds. We guaranteed, so money market funds were too big to fail. Also, the big five banks were too big to fail. So we've driven that into the head of investors. Now we have all these cinder blocks around the United States failing in regional banks. That's driving capital, hundreds of billions of dollars out of regional banks into money market funds. Why would you have money in a regional bank where you're only protected to 250,000 when you could just put it in a money market fund and right. Uncle Sam can't. So essentially the previous crisis is actually sowing the seeds for this crisis.
That's so crazy.
It's amazing. And so until there's a much more broad Republican and our partner in Washington is great. We did a call yesterday with ACG Analytics and a couple of hedge fund clients, and the CIOs were just really pressing the team in Washington around, okay, where are the Republicans? And the Republicans and Democrats are miles apart in terms of getting a bigger backstop. So you remember the scene from Jaws where Quinn says, we're gonna need a bigger boat, right? And that's the case. We need a more broad package to protect the regional banks. We don't have it.
So, Larry, do you have any ideas what that is? Like, is that a higher limit for the FDIC insurance? Like, are banks too big to fail, but are they too big to save as well? And do the bigger banks need to be broken up? Which way are they likely to go, Larry?
Well, one of the great sins of this crisis is that, Roblox CFO and Roku CFO, I mean, come on, guys. Come on. They had tens, if not hundreds of millions of dollars in Silicon Valley Bank. I mean, these guys are professionals. They're chief financial officers. And so for FDIC insured protection, for that to actually protect the elite CFOs, the companies, that's got tremendous political hair on it, which there's no question in talking to different senators around the Hill that our team in Washington has been doing. There's no question that there's going to be some type of determination or separation of household deposits versus corporate deposits. And so corporate deposits shouldn't have the same, you get a little old lady or a dentist in Ohio that has the same protection as the Roku CFO. I mean, come on.
It don't make sense. Yeah, it doesn't make sense.
Absolute madness. And, in the old days, people would do their homework on like the duration and like everybody was sleeping at the switch. And you know what? Goldman Sachs was sleeping at the switch as well, because they, a month ago, were calling for a soft no landing. What all that means is they clearly didn't see this credit crisis brewing. So the bottom line is there'll be some type of some limits on the corporate side, and then there'll be expansion on the household side. But in terms of breaking up the banks, the bank lobby is too big. If you didn't break up the banks after Lehman, you're never going to break them up, right?
Yeah, that's right. So what's the right move to protect yourself right now, Larry? Is it gold or is it silver? Do you play the gold-silver ratio? What would you do?
Well, at the very top, the big picture, the previous decade was a deflation decade that was driven by deflation certainty. And when deflation is very certain, for a number of reasons in the previous decade, money moves into longer duration assets. So that's bonds, growth stocks. Those are the most two simple, what we call financial assets. So the 2010 to 2020 period was probably in the next 100 years, probably be the most spectacular, impressive outperformance of financial assets versus in the United States versus just about everything else. What happens is when inflation becomes more sustainable at a higher plane, that comes from the Fed having to soften here, right? So the beast in the market, the financial conditions, that serpent in the market is basically forcing the Fed to slow down when inflation is still pretty high. And that is going to give you a more elevated, sustained inflation path, nowhere near 2%. So if you're at 2% inflation and deflation risk is certain, then long duration financial assets are going to do great. If you're in a period of 3 to 5% inflation that hangs around a while, that forces trillions of dollars into what we call hard assets. Now, gold, silver, uranium, copper, we can name a whole bunch of different companies that are in the value space. So value stocks do much better in a sustained inflation regime, whereas growth stocks do really well in a sustained deflation regime. So I think we're probably in like the first, second inning of the most impressive migration of assets, a colossal migration out of financial assets into hard. Believe it or not, there's still 15 trillion in the NASDAQ 100. 15 trillion. A year ago in January, that was 20 trillion. So we've had a $5 trillion migration, but there's only in the XME and the XLE, which is the XME is the metals ETF, and the XLE is the oil and gas ETF. There's only like $1.8 trillion in those two big, and then the GDX has about 300 billion, I think. So in gold and silver ETFs. So there's just, and the entire uranium space is only worth $30 billion. So you're talking about, there's no money, like there's really not much capital has moved into hard assets. The gold silver ratio, which you brought up, is it's very important. In past bull market cycles, it's hit this like 35 to 1. It's even got down to like 18 to 1, I think in the 70s. But the average commodity bull market, you see the gold silver ratio in that 30 to 40 range. This past week and a half, it's broken a key technical level, which I'll share in the charts with you guys. But it's broken, and when it breaks, it typically runs like a deer in the valley. And you're talking about a break from 86, I think was the level. It's now like 82 3 handle. The probability that this moves down toward the high 60s over the next year is very strong, which means that your SIL is going to outperform. So your GDX is going to underperform your SIL, which is your silver miners, or your GDXJ is your junior gold miners, versus the SILJ, which is your junior silvers. And so your miners typically outperform the hard metal in a bull in the early stages of the great bull runs that we've seen, like 2009 to 2011. Remember, when the Fed stops, when that beast in the market knows the Fed's at the end of the hiking cycle, that's where silver really starts to move against gold, and that's where we are right now.
Well, Larry, we want to thank you so much for coming down to Wall Street Silver, and hopefully the next 2-3 months we can have you back just to see what happens in the market.
And thanks for your leadership, your inspiration, and I follow you on Twitter, and it's really valuable, your insights, and you're a great aggregator of the thought stream of the hard asset to from the financial asset to the hard asset transition.
Yeah, we just need $1 trillion or 2 from the NASDAQ now to come into precious metals. Alrighty, take care, Larry, and we hope to see you soon.